This is the first Naturally Bay Area event of the year, 2021. Very happy to kick this year off. Very happy to kick this year off with a fantastic panel and with an awesome opportunity to be able to help everybody dial in their pitches as we start to prepare for the new year, optimizing it for this new environment that we're all in. So welcome to Pitch Camp. We're joined by Andy Whitman and Craig Bartlett of 2X Growth Partners and Consumer Growth Partners, and being able to also joined by Trishna Saigal of Down to Cook. And so today we're going to be hearing from them. This is an opportunity also for the entire audience here in attendance to be able to ask some questions and to be able to receive some answers. There will be a whole section for that. Please enter in your questions into the Q&A section. And with that, I'm going to turn it over to Andy and Craig to kick us off.
Great. Thank you, Pete. We'll share some screens and get rolling. Craig and I are going to tag team through this. I'm Andy Whitman. I'm the founder and managing partner of 2X Consumer Products Growth Partners. Craig and I are going to talk a little bit about, first on, what you should think about pitching, what happens in sort of the new normal, but quickly, 2X Consumer Products Growth Partners, not because we care about giving a commercial, but so you understand the context. We are the longest tenured investor in our little sliver of the economy in growth capital for branded consumer products. Most of the companies we partner with are 2 or 5 or 10 or 20 million in revenue. And most of the investments are, 5 to 10 as sort of a more typical, and as small as 2, and we've done well into the 20s in terms of $1 million checks. So with that as context, we're all about industry help that happens to come with a bucket of cash. We wanted you to have that, again, not for the commercial, but so you understand how we come at this. We've been doing this for 20 years, and we have a chance to meet with and see financials on 700 companies a year, so hopefully that informs what you're going to see. So with that said, real quickly on the first page here, think about your pitching. The most valuable commodity you have is not your money, it's your time. So try and talk to the right people at the right stage. Craig and I are nice people, but if you're looking for a $250,000 investment, we're not the right folks. And if you're looking for $50 or $100 million, we're not the right folks. So just spend your time wisely. Be clear about your goals. What are you trying to raise and what do you want? Do you just want capital, which is, by the way, perfectly acceptable? Do you really want help? Do you want some of both? Think about it. Basics of pitching, tell your story. Really explain why you're different and special. The story behind the numbers, it's really not about the numbers. Why you and your team can do this. And if you're so early on that it's you alone or you and one other person, how you're going to build out the team. And be upfront, call out the risks, talk about how you're going to mitigate them, et cetera. If I'd wish for you to have 3 things, there are some examples. You can go to the 2X Partners website. There's a resource section, a 1-page executive summary. Some people would say you can get away with 2 or 3 or 4. I'd say 1 page. The sample there I actually think is fabulous. We can't take credit for it. We did some liberal adaptations of something from the Angel Capital Association. It's 2 cavemen for the business plan to introduce the wheel. It's actually kind of fun. 1-page executive summary, a short PowerPoint with the reasons for being, and an Excel bottoms-up model. A tab on your revenue projections, how you got there, number of doors times this, or if you're online, number of consumers times AOV times this times that. Build up from the bottom up. Guy Kawasaki does something called the rule of 10, 20, 30. You should Google that. 10 slides or less, so far so good for us. 20 minutes, so far so good. Greater than 30-point type. I don't think we're entirely on that plan, but so look that up. He lays out, here's what the 10 things you should think about, but keep it concise to start. The 75 or 100 page is just too painful. So those are a few basics of pitching. I'll turn it over to Craig as we talk about sort of this COVID environment.
All right, so optimizing your pitch in the new normal. What is different in light of COVID-19? So we know that COVID-19 has been hard, but we hope that your businesses will emerge as better and more focused businesses. So across our partner companies, they've taken actions like optimizing trade spend, reducing the number of SKUs they have to just be the best performing SKUs, reevaluating their OpEx, and we would hope that your businesses are doing that as well. When pitching today, you want to make sure that your business model and growth plan and overall pitch reflect the fact that COVID-19 has happened and the world has changed. So I thought one interesting fact to bring in was when you look at e-commerce's percentage of the grocery market, pre-COVID, it was expected to be 4% in 2020. In light of COVID, it's gone 2.5 times bigger to 10% of the grocery market. And now it's projected to be 20%, another doubling in 2024. So your business model and growth plan should reflect that change in the world and how you're taking advantage of it. Do you have a Shopify website now? Are you using Instacart? Do you have an Amazon plan? Those sorts of things. Moving to the next bullet, emphasizing the actions you've already taken in response to COVID. So the nature of startups is things go wrong. That happens in every startup. And what investors want to see is how well you've adapted to the adversity that has come your way. And COVID-19 has presented a variety of different challenges. And so whether you're able to pivot and whether you're able to get your team behind a new plan is extremely important for investors to see. And you want to emphasize what you've already done to date. You want to include key metrics for your business overall, and especially today for its different channels. So overall, we always like to see net revenue, gross margin, contribution margin is becoming increasingly important. The way to think about that is it's gross margin minus your freight out and warehousing and your commissions from different selling expenses like brokers or Amazon or Shopify. And in the world of e-com, contribution margin is increasingly important. In brick and mortar, you want to see a lot of the same metrics that have been looked at for a long time. Average retail price, ACV, average items carried, dollars per TDP, which is a metric for velocity. In e-commerce, you want to look at things like your customer acquisition cost, average order volume, lifetime value, repeat rates. And one thing that I'll actually call out as I think about this that's not directly in this deck is if you could show your digital engagement, that's increasingly important too. So how big is your email list? What are the click-through and open rates for those emails? How big is your social media following? What is your engagement rate there? What are the number of likes and comments that you're getting per post? All right, and then moving to the next bullet, you want to demonstrate your ability to succeed if COVID continues. You want to be able to thrive during this time, not just survive. And you want to have upside when the world goes back to hopefully a more normal. And lastly, you want to manage cash prudently. This is always important, but is increasingly important today. I'll pass it back to Andy.
Great. And somebody in the margin asked if these slides will be available. They'll actually be posting the video, which has the slides inherent in it. I won't spend time here, but available at the 2xpartners.com website is both a white paper that you're seeing an image of and a video that we did with the Naturally Chicago group around 10 reasons investors pass. Reasons why investors may not participate in your business. If you understand why they often pass, hopefully you'll be able to do some things about it. So with that said, our contact information is here. If we can be helpful, email Craig or myself, and we'll turn it over to Trishna.
Wonderful, thank you. All right, so I'm just gonna share a bit of background on Down to Cooks and kind of my experience over the last year in fundraising and some takeaways that I've learned. So hi everyone, I'm Trishna, I'm the founder of Down to Cook. We sell an add a veggie protein mix the way it works is you add a fresh vegetable to our mix, and then you can use it to make a ground meat alternative. So you can make patties or meatballs or crumble. It's very veggie forward flavor. And this was really created out of a need to make kind of healthy plant-based protein alternatives. So we started back in 2019, and we were very food service focused pre-pandemic. And in January of last year, we just launched our retail package, which you'll see on the slide. At the Fancy Food Show, we were talking to retailers. Our round was coming together. We were fundraising a pre-seed round to really kind of launch into retail and grow our food service business. But then, right around March when that round was coming together, a couple of our investors pulled out, and then the couple that were left didn't feel comfortable contributing, knowing that the round wouldn't be full. And plus, given the fact that we were so food service focused, there was just a little apprehension about where we were going to go as a brand. So we spent the 2020 pivoting. We launched on Amazon. We worked on our website and a number of vegan platforms. We had a big win this summer launching on Good Eggs. And then we started to see a lot of returns on all those platforms towards Q4, where our revenue really actually surpassed where it was even pre-pandemic. So now I'm starting to raise again. And we opened our pre-seed round. We have about 20% of it filled. And I just kind of want to share a couple of things that I've learned in that process. So, one is and we've already mentioned it, but really like understanding your channel strategy and how it shifted during this time. So for example, I was food service focused before, and it's not to say that food service won't come back, or, it'll definitely come back in a different way. But what we've done is we've pivoted to, being in some meal kits, and, we're still providing, the food somewhat prepared to customers, but they're getting it in a way that kind of suits the current climate. And it's still giving them that experience with added veggie in a cooked fashion. And then the other thing I would say is kind of, what I learned the hard way a bit was framing what happened this year. So, we pivoted, and then I did, redid my deck, and I shared it to, the new investors that I was talking to. And, I didn't mention food service because I didn't want to kind of put anything negative in my pitch, but they asked all the metrics that, Craig and Andy alluded to, like my LTV, my acquisition costs. And the truth was we just launched on Amazon like a few months before that. So our metrics weren't wonderful. And for a company that had been around for 2 years, like it didn't seem like we had grown as much as we should, but it was really because of all the, and in our lens, like we did a fabulous job of pivoting and getting into these platforms and seeing the growth we had, but I wasn't communicating that story in my pitch. And I realized after the fact that I really should have just owned it and talked about how we were able to kind of grow and how we've changed our strategy and how that's going to make us successful in the future as well. And then the other thing I've felt was really kind of a detriment and unfortunate setback of all of this is like not being able to network in person, right? When I think about like my lead investor who's like super, supportive of everything we do and has made a bunch of introductions for me. I met him in an elevator at the very first Naturally Bay Area event. And like, that doesn't, who's going to go in an elevator with someone these days? Like, that's just not going to be happening for a while, right? So I've had to be really creative about how I've met other folks, other angel investors, because we're really early. We're raising a pre-seed round. So it's a lot of angel investors, and those are even harder to find than a lot of the institutional firms. So every person I meet, every kind of industry expert I talk to, I always ask who they know that would be a good fit for our mission. And I continue to try to network through this kind of digital world. And it's helped. I've met a lot of angels that, I didn't know previous to doing this round. And I think be creative in how you meet new folks. So those are kind of my 3 takeaways, but I'm happy to answer any questions about it.
That's
Awesome.
great. Thanks, Trishna. We've gotten some questions in the Q&A. Encourage people to put stuff in there, not into the chat. We can do a good job on one, but it's hard to toggle. Trishna, one of the questions right away is, besides elevators, where else did you find it productive to go when you're first starting out to try and meet folks?
Yeah, the other thing I'd say is we were fortunate to have a platform to pitch this year. So we pitched at Food Funded, we pitched at Expo, and then I had folks reach out from there. We've applied to a bunch of angel networks. There's a number of food ones and non-food ones too, but like we're applying to the Berkeley Angels one, so it's where we're located. So I think that those could be good places. Yeah, it's just, but the other thing I would say is like probably the most success we've had is with other founders and other industry experts, people who have been working in the space for a while. Like we've worked with a number of consultants that just know a lot of companies and investors and people kind of more appropriate to our stage. So a lot of contacts have kind of come in through that channel as well.
Great. Trishna, if you want, feel free to cancel your screen share. Craig, you and I can chime in, maybe even Pete, in terms of other places to look for early stage capital. One of the places I love to encourage people to think about is if you're in the shelf stable ambient part of the store, who else do you know that's been in that part of the store that has had successful exits? Doesn't have to be that part of the store, but if, for example, you're in the cleaning products world, somebody that was at Method would get what you're doing, especially if they're past their non-compete. Maybe they could be an interesting investor, either the entrepreneurs, senior people that maybe made some money in the business, or in your backyard, you've got, current or retired Clorox executives right in the Bay Area. So think about both entrepreneurs and team members and sort of larger company folks that would get why your product is special or different. So that's where I like to encourage people to start. Geographically, you're best off to start in your backyard. Normally, in a COVID world, I don't think that matters as much because you're not going to have coffee with anybody. But that's one thing that I would encourage people to think about in addition to what Trishna said. Anybody want to add anything there? Go for it.
Let me tag on. I think, Andy, you kicked off with we're bigger than a bread box. We're smaller than in terms of some of the investments, right? They may not be right sized for your group right now, but at the same time, I think that there's a lot of value in making sure that you're making the right connections just with those who you think can be strong strategic partners and investors down the road, who also have a network just built into their own lists that can help you today, right? So they may have access to family funds that they think are going to be right sized, that can help prepare your company, your brand, and the opportunity for an investment further down the road. So just something to consider. Make sure that you're reaching out to those who you just think are going to be smart, values aligned, and also good dollars down the road that are going to be great partners for you.
That's great. In a related question, Trishna, somebody asked here about the angel groups you made reference to. Did you, they didn't catch the name. Can you just share what it was you referenced?
Yeah, I thought I typed the answer in. Maybe it didn't go through, but
no.
Yeah,
go ahead, just say it.
Yeah, so there's the Food Angel Group, there's just the Angel Group, Berkeley Angel Network, and the Glasswall Syndicate. The Glasswall Syndicate's plant-based focus though, so those are a couple that we reached out to.
Great. And by the way, on the 2xpartners.com website, in the resource section, it's a little dated, so we apologize for that, but about 2 years ago, we did a really deep dive of all the angel groups in the country, which ones have invested in CPG, which ones haven't. So feel free to look there. Know the caveat of it's a little bit dated. Craig, some folks asked about recommendations from industry data. If you see that question, they don't have a big budget. Do you have some thoughts that you'd want to add? And I can chime in as well.
Sure. I mean, I would say that ask whoever you think has access to that data. So a lot of times brokers can help provide you with some of that data. Retailers can help provide you with some of that data. I think that's probably the best way to start. And that's brick and mortar focus. I think on e-com, you should have access to data as you start selling.
Yeah, I think that's great. And I would add in, if you're doing any business with either Catalina or Ibotta, they have a lot of data that can help you. And lastly, if you have a college or MBA intern, particularly the latter MBA interns, they will often be able to get access to Euromonitor, Data Monitor, you know, that kind of stuff. Let's
Building
see.
on that,
Yep,
Andy,
go for it.
there's also a wealth of data right now that is available on IRI's website, which is free category-based data. And if you go in there and look at IRI, I believe it's under COVID-19 resources, you're going to find a number of presentations that are already built, ready to go with infographics, et cetera, that may help you from a category perspective as well.
All right. Let's rapid fire through some other questions. Somebody asked, when's a good time to raise? The answer is when you don't need money. That's the easiest time to raise. Is it hard or easy to raise for snacks made outside the USA? I think there are plenty of folks that are nervous about supply chains outside the US, either because of, you know, contamination or just the complexity of supply chain. It's not impossible. Many countries, Canada, et cetera, are a lot easier and less scary than China. But it definitely raises a complication. How do you know how much to raise pre-seed? Well, if you've done some cash projections, you know, double what you think you need or triple it, because it always takes longer than you think and costs more than you think. But if you go to the Hirshberg Institute website, Gary Hirshberg does a really nice cash planning Excel that you can download. So that's a few things there. Let's see what else. Ideas of how to make digital or online connections even when you've not met them. I'm not sure I'm following the question. Did you follow that, Craig or Pete?
Yeah, I think they're saying if in a COVID world where you're trying to make digital connections with people that you've never met in person before, how do you do that? And I think LinkedIn is your best friend there. The LinkedIn app has much more functions on it for free than the LinkedIn website. So I'd highly recommend downloading the app. And then I think you start with an outreach like any other. And I think you can follow up with product samples and other ways to, you know, kind of continue to get in front of that person and build a relationship.
I'm going to make a shameless plug as well. We're going to be in a digital world for a while here at Naturally Bay Area. And there are Naturally affiliates in cities across the US. Sign up, attend some of the Naturally events where you're going to find that all of us will be throwing different networking events, opportunities for people to connect online. And, you know, even one that's coming up here very soon, which is going to be at our Pitch Slam. There's an opportunity for brands and also for service providers to be able to take part as a virtual booth at our Pitch Slam on February 11th and also 12th.
Let's see. There's a question about if we're just starting out, should we include potential projections? Sure. Everybody wants to understand what this looks like. But if you're literally a seed idea and this is completely just like a napkin idea, you got to caveat by saying these are our best thinking and we'll refine as we go.
Knowing the size of
people, go ahead.
I was going to say, knowing the size of the market is important for pre-seed ideas. If you're a keto bread, you want to know how big the bread market is and how big the keto portion of it is.
Yep.
Got it.
What categories are attracting capital? Are you seeing more so somebody's building a plant-based snacks and desserts business? This is Jamie Fay. It's also perishable. And so thoughts on that?
I welcome anybody to chime in, but you know, in certain ways, COVID has made things more complicated for perishable businesses because it's harder to do on e-commerce. On the other hand, frozen, for example, is a booming category. So some people that weren't interested in frozen before are now. I think at the end of the day, places that are interesting businesses will attract capital. If it's not really differentiated, we're going to have a problem. We got a bunch of questions here. Pete, one of the questions is, can we run a few minutes long to get a few of these questions in, but we'll keep going. You can think about that. Do you have a food service product? If so, what types of objections have you experienced with potential investors who are nervous about COVID impact? The people, and Trishna talked about this, that are solely food service have had a lot of challenges raising money. Most of them have pivoted in some fashion. So you need to think about back to the what makes you special and different. You know, it's really a matter of if what makes you special and different still applies in food service, or if it applies in food service and retail, and you're going to do more retail while food service is a little less real, you know, go there.
Let's tag onto that, Andy, with Michelle's question, which is really about a collagen-based protein bar and the need to be able to differentiate, and also to explain that maybe the category isn't too competitive, and then how best to be able to present out this new opportunity. And where we're going with that is that let me address this. So Michelle launched a collagen protein bar months before the pandemic and had maintained steady growth digitally amidst the pandemic. Also evolving her portfolio into snacks and facing some investor apprehension because they're still associating them with just the bar category and it being too competitive, as well as having been hit pretty hard by the pandemic. So how would you recommend mitigating their concerns, similar to the food service concerns? Any tips?
Sure.
Go ahead,
Greg,
Andy.
you want to take that?
All right, I'll just start quickly by saying that I think you want to emphasize, you know, when you're in a competitive category, the beauty of that is that you have a lot of other brands educating the consumer on what you're doing. The downside is that there's a lot of competition and the ability to differentiate can be sometimes challenged. So I think you want to emphasize the pro of it and make sure that you're showing your point of difference. And specifically, if investors are showing that their concerns around bars are an issue and you're moving into snacks, I think it's just all about how you're going to acquire consumers, do the right channel strategy to make it work, because bars will continue to be an important category, just like snacks.
Yeah, I think there are very few categories where somebody's going to say, oh, that's not competitive. So you really need to peel back the onion, and often that's a euphemism for why will you really stand out? Let's see. Bonnie asked a question about, is there a New York equivalent? And yes, there is a New York equivalent joining as part of the Naturally Network.
Look it up, Naturally New York.
Yeah. Greg asked a question about when's the right time in the due diligence process to grant investors access to your data room. If you have a data room, which many very early stage companies don't, you know, as early as they seem interested and you seem interested, there's no right answer. You know, don't overcomplicate it. If they want, you know, every check you've ever written, you know, some early stage businesses, you know, every contract you have ever written, every check you've ever written, every email you've ever written would fit on your dining room table with plenty of room for 4 of you to have a meal. So I don't mean that sort of overly flippantly, but just don't overcomplicate the diligence. It's share the important stuff and anything else they could possibly want.
Andy and team, and for all out there, we're going to go about 4 minutes more, so we get to 12:35. So let's do this. Let's cover off on the Q&A that's in the set right now, because we got some good ones, and then go from there.
Great. All right. Let's see. So we talked a little bit about crowded category. Michelle asks a related question, which is, pitches, tips to pitch if you're in an oversaturated market. I think really it's a similar question around, why are you special and different? Why is this interesting? A very important point that applies to a number of these, which is, remember, you're not just selling a retailer why they should take distribution of your product. You're not selling a consumer they should buy your product. You're selling somebody to invest in your company. It is a different story. Craig, you want to grab one?
Sure. Let's see. Totally understand that margin is king, but it takes growing in volume for small businesses to achieve better margin. Are investors open to that story and journey? I would say yes, if the story is real and believable and clearly defined. A lot of times we see projections where there's substantial margin improvements, but not much to back it, and that doesn't provide us confidence. Oftentimes we see the other story and it's believable. So it depends on how much there is to back that besides just volume.
A good way to be able to do that from having some experience with it is if you're looking at your COGS, where they're based today, and you know that you're running on minimum order quantities and you know that there are efficiencies you're going to be able to achieve, both in terms of the purchase size on your ingredient batches, as well as probably by throughput and run rate, as you're starting to plan those things out. That's an easy place to start. You're going to get more efficient within all the planning and the promotion and selling side of the business as well. So, some areas that you can kind of think about and continue to focus on.
There are two questions here as it relates to models. One of which is, are there any good resources for building CPG Excel models? And a different question of how detailed should it be? The more detailed, the better, or is it better to keep it simple? I invite others to chime in, but let me suggest we tackle those two. The truth is there's no really good standard model. But if you think about each line of the P&L, I'd think about a tab for each line or group of lines. So you have a tab for your, gross revenue. That's, if you're talking about brick and mortars, it's number of doors times, velocity per door. Maybe you do it at a SKU level if you're a really simple, 3 SKU business, et cetera, and you build that up. Then there might be a tab on your trade spending. Then next, there might be a tab on your COGS. And this is where if you break down your costs to the prior question about gross margin increasing, you can build out, these are my packaging costs, these are my product costs, these are my co-packer fees, however it is, and you build up and you go all the way down your P&L, and it's easy to follow that you're not just arbitrarily thinking you're going to get a 20% reduction in cost of goods with nothing other than we're going to get scale. So I would think about that. A little bit more details is better than a little less, but be careful about false precision.
All right. Should we do last question? Is there a typical multiple that food businesses should expect at seed or pre-seed stage raises? It's hard if you don't have a base of revenue to apply a multiple to. So what I would recommend is think about the amount you're raising and the percent ownership that you're selling to the new investor. It's typically a better way to think about it at that stage.
Yeah, and you wouldn't start a business if you didn't think it had some value. So maybe it's $1 million of value or something. But, pre-revenue or a business with $50,000 or $100,000 of, trailing revenue, when people start talking about $3 or $5 or $10 or $20 million of pre-money value, that it's out of the range of reasonableness usually.
I do want to tag one question onto that, Andy and Craig, for you both, is how have you seen those multiples change, or how should maybe brands be thinking about it today versus a year ago? And I'm talking about valuation.
Go ahead, Craig.
I think for the top businesses in our space, the multiples haven't changed. Maybe even they got slightly more competitive. I think for most of the other companies, I do think there's been a bit of a compression in multiples.
Yeah, and I would take that a half step further, which is the great businesses are having no trouble raising capital. The ones that are not great businesses are still having trouble raising capital. It's the ones in between that are maybe interesting, maybe they're differentiated, maybe they're not. Those are the ones that previously had raised some capital and sometimes raised a lot of capital. Those are the ones that are having trouble. So it's not just that there's compression on valuation. It's some of them are just not being able to raise because they don't have an economic structure that makes sense, or they're not as differentiated as they like. But again, if you're building a great business, people want to be part of it.
Agreed.
And I know we're low on time, so maybe that's a good place to end.
I think it is. And there's been a lot of really good stuff shared today. Andy, Craig, thank you very much. Trishna, thank you for sharing your stories from the trenches as well. And thanks to everybody for all of the questions that have been raised today. So appreciate you being here for Pitch Camp. I highly encourage everybody to attend Pitch Slam. We've got a great group of brands that are going to be pitching. Finalists are in the works of being chosen. And in addition to that, we will be tagging onto that an innovation and discovery expo, a great opportunity for brands to be able to participate there and get some additional information, set some meetings with advisors, investors, and other brands as well, just to be able to continue to network. Thanks to everybody today. Thanks for sharing all your info, and we will see you soon.